Okay, with the income statement, we're in Unit 2.2, Recognition of Revenue and Expenses. As you can see, we're dealing with a lot of different things here. Paying things out and watching our net earnings grow. Now, the income statement is essentially a summary. It summarizes the revenue, earnings, and expense accounts into one single number. Now, this number that I'm talking about is vital, as previously mentioned, because net income equals revenue. Now, pay attention, you may see this again. Anytime you see or hear revenue, that means an increase in assets. One big thing is a return on your assets. A return on your assets helps users of financial statements evaluate profitability of the business, whether it's employees or somebody auditing your business. Income and expense accounts are just part of what's called owner's equity. Each help explain increases in equity based on the earnings. Back to the income statement. What you want to do is take the number that appears in the statement of owner's equity. That number will get combined into a final number for income and expenses that I previously discussed. With that said, you may see this again. That final number is called owner's equity end of period. You'll see that at the bottom of the income statement. Owner's equity end of period also appears in the balance sheet simultaneously. Keep that in mind. You may see that again. Let's discuss the liability section. Very important for the owner, because in the liability section is where the expenses go. Expenses are accounts that explain why assets went down in the business operations. Not necessarily a bad thing, often expected. For instance, every business has an expense report, a separate account to document and keep track of everything that you are paying out or expensing to the business, relevant to the business. It must be relevant to the business. Bottom line though, expense accounts explain decreases in equity as a result of using up all assets available. Remember that. Decreases in equity as a result of using up all assets. Now, the final part of this liability section, where the expenses occur, includes accounts called deferred revenues. Deferred revenues, here's some examples. Annuities that a company can purchase. Ancillary charges that the business may expect or not expect to receive. Taxes. We all pay taxes, but so do businesses. Business entities pay different taxes and must account for them. Also, other income is often accounted for. Businesses often subcontract out and create other LLCs and other small businesses within their business operations and their large entity. This must be accounted for and is obviously the opposite of what would be considered an expense, but nonetheless a deferred revenue. And that's what we have from 2.2, recognition of expenses and income.